Hey there, it's Leo with MV Realty and MV Home Loans. It's another great morning, TGIF, it's Friday, and I have a couple more questions that came in that people are excited to know about because they're wanting to either get a mortgage or they're wanting to buy a house and they're wanting to ensure that they don't overpay on a property, and that if they go ahead and get themselves a mortgage loan, that they are measuring their purchasing power and getting the right product for that future purchase, so they have the best, so they're most prepared to buy a house and commit to that 30-year mortgage. Let's dive right in. First question that came in says, how does my credit score affect my loan qualification? This is very important, a great question. I'm glad it was asked. Number one, credit determines whether or not you're eligible for a mortgage loan or not. Getting a mortgage loan requires that you meet the bank's minimum credit score. I have seen mortgage loans as low as 500 through the FHA, as long as you put 10% down. I have done loans with as low as a 530 credit score with some banks that allow you to go that low. They won't give you the most favorable rate, but at least as long as you have the income to support the payment, they will qualify you for the loan. And a couple things that you can write down in terms of how the interest rate is determined. So number one, it's determined by your credit score. There's three numbers that you have. They will always use the middle numeric, not the highest number, not the lowest number, but the middle number, the middle numeric of your credit score. And also the type of property that you're buying, whether it's a residential, commercial, or agricultural property. Also the loan term. If you remember from a previous video, the loan term is how long the loan is going to be for. Is it for 30 years, 25, 20, 15? Very important. And the LTV. The LTV is the loan to value ratio. Think of the loan to value ratio as the property appraised for $300,000. I am putting 50% down. So the loan to value ratio of $150,000 to the 130 is 50%. So I have a 50% loan to value ratio. 50% of my purchase is being financed. 50% of my purchase, I am putting cash down. Once again, to recap, interest rate is intimately tied to your credit score, to the type of property, the loan terms, and the loan to value ratio that you are setting in terms of that mortgage loan that you're applying for. So a similar question that someone asked, how is my interest rate determined? Interest rate is determined by your credit score. If you have a high credit score, your interest rate will be low. If you have a low credit score, your interest rate will be high. Why? The lenders, mortgage bankers, mortgage lenders, mortgage brokers like myself, they're going to determine risk or your past history in making payments based on what creditors are reporting. If you have not been making payments on time and you've missed payments, well, that trend gets measured through your credit score or your FICO or your Beacon score, right? And what it does is it gives them a risk matrix. What that means is if you have a history of making late payments or not making payments at all, well, then that's going to lower your credit score. And if I am the lender and I'm giving you the money, right? If I can't rely on someone to pay $500 on time, it's also going to be a risk to lend you $500,000 when you can't pay me the $5,000 of a mortgage on time. So credit is intimately tied to the rate that they're going to offer you based on the risk that they see that appears on your credit report. So that's super important. You want to take care of your credit, and credit is not cash, right? So we want to distinguish the difference. So that's how interest rate is determined, so for all of you out there. that are looking to buy property or looking to improve your credit. The next one that came in is also, what are points and are they worth purchasing? So discount points are fees paid to the mortgage lender at closing in exchange for a better rate. Now, we often refer to this as buying down the rate or paying interest up front. You're gonna pay it anyways, but if you have the cash, right, and you wanna lock in a lower rate for the next 30 years, pay the discount points.